Hi, welcome to the Market Alert for Wednesday, the 15th of March 2023. So things are getting no better behind the scenes. The inflation rate yesterday, etc., and also more on the banking sector this morning as well. Okay, let's get on with it and have a look. So yesterday there was a relief rally ruined by ratings agencies. That's Moodys. We'll look at that in just a second. Russia and Bitcoin was bid higher. Stocks and yields climb on inline CPI and no more bank failures. That was yesterday. Was no more bank failures just yet. The CPI shelter inflation hits record high as Americans' real wage drops for 32nd straight month. This is a new indicator that the Fed were using, and unfortunately it's backfired on them. It's up 6.14 year on year. This wasn't mentioned in the numbers yesterday. Those came out as forecast yesterday, didn't they? If we just go back a day there, you'll see that they were in line. What a surprise. Apart from the core CPI, which came out 0.1% higher. While we're here, let's just have a look today for economic news. We've got the annual budget today for the UK spring budget, and then core PPI, retail sales, Empire State PPI, and retail sales as well. And everything's out today at 12:30. But going back to Moody's, they've downgraded the US banks, as can be seen here on CNBC yesterday. Moody's cut outlook on US banking system to negative, citing rapidly deteriorating environment. Well, we know it is, and even the Daily Mail picked this up yesterday as well. America, 620 billion ticking time bomb. The FDIC reveals extraordinary amounts of unrealised losses across US banks amid fears more will collapse after the sudden failure of SVB and Signature Bank. So again, no surprise. Now 620 billion seems an awful lot in losses, but going back to 2008, we had over 800 billion was printed, but under the Bush administration to save the bank. So I don't know. I mean, look, this last weekend, Yellen said she wasn't going to do any bailouts. And then at the last minute, she decided to, and covered all of the depositors' money. So, you know, I mean, there's a lot of headlines flying around at the moment, and I agree that it's certainly not over by a long shot. But will it be allowed to fail? That's the big question. I very much doubt it, unless all of the smaller regional banks are absorbed by the major banks, which then gives them even more control. Who knows? But 620 billion is a lot, there's no doubts about that. But like I say, if you go back to 2008, the Fed printed 800 billion to bail out the banks, and in the UK we printed 600 billion to bail out Lloyds and Bank of Scotland. Completely different situation this time because of the regulations that were put in place following 2008 have come back now to backfired because of inflation having to raise rates. There wouldn't be a problem in the banking sector if there had been no rate rises required. But because given that banks have to hold a certain amount of bonds, long-dated bonds with low yields, then rates go up, bond values go down, and they're painted into a corner. And then they've got to try and offload them at the lower prices, and that creates the losses. And if you remember back to the John Titus video that I recommended, and I'll put it up on the screen, it was all detailed in there. He got it absolutely spot on, and they've just released the December quarterly one as well, which again I'll put the graph up so that you can see that as well with the losses. Okay, so this is the video that I recommended. Why is the Federal Reserve provoking a financial crisis? And the chart here, the unrealised losses on investment securities, this is within the major banks. He showed the graph there, but that was only up to September. They've now issued the latest report out to December, and you can see it ease slightly, but you can see how deep in the water the bank's losses are. So this is what relates back to what you're seeing here in the Mail and all of the other videos and news items online. So yeah, the banks have certainly got a problem for sure. I mean, you can see how big the problem is there. Around 620 billion in losses. It has, like I say, eased slightly, but some of the bigger banks have been able to offload some of those poor yielding bonds, but that's about all. So anyway, let's see what happens going forward, but that's behind all of the rest of it, what's going on at the moment. It certainly isn't going to go away, is it, in the short term? And what's amazing is the stock market's resilience at the moment as well. So let's move on and have a look at it. So in the Dow for yesterday, you can see them buying back into the market. They're trying to move the market up on the overnight as well. Needs to get back above the 200 MA if it is to move higher. But it's amazing how the market's just ignored, what's going on and what's in the background. Yesterday, we saw the market rallying up. It did have a bit of a sell-off at one point, but that soon changed its mind and brought the market back a good 62% there from the high to the low there, well 78% to be precise, and is attempting to get above that 78% and the 200 MA at the moment. So there's no sign of any more weakness in the markets at the moment. We've got a stay of execution. And I suppose if you're holding stocks and the banks have got problems, if you'd actually offload all of your stocks, knowing what happened in 2008, you'll get out before the downdraft. You move the money into the banks, and then the banks have a problem, and you still lose your money. So it's a tough one of what to do with regards to this. So the Dow at the moment is, and markets are sort of ignoring it and saying, well, we'll just carry on and see if we can get the markets back on the upside. There's a perfect example of that yesterday. We've got war, recession, we've got strikes, we've got, you name it, we've got it going on, haven't we, at the moment? Yield curve inversion. And yet the markets yesterday were up. Banks collapsing as well now at $620 billion in unrealised losses. It's just, you just can't make it up anymore, and the market continues to try and fight back. And the highs that it's in, if we look at the monthly chart of the German DAX there, you can see that we're still retracing from the sell-off from last year from the war. I mean, it's just incredible, given the backdrop, I say, of all of the economic news. The madness never ceases to amaze me, or the lack of reality. So yesterday, the DAX buying back into this, down at the support levels that we saw yesterday at 62%, and also at the 14,901, well, 15,000. Market stormed up yesterday 300 points. As can be seen here, and 38 and 50 there. In the 30-minute charts, it never stopped, did it? It just kept moving up in the US with the inflation that came out with the core actually increasing, and the shelter indicator for the CPI also at its highest. The market continued to move to the upside. All we need to do is to get through the high now and move to and continue moving up. That said, watch out for the open, because the market at the moment has this thing about selling off at the open, then finding support and then trying to bring the markets back. So something to observe there. In the 5-minute chart for yesterday, you'll see precisely that. So we had the sell-off here in the futures, then the market traded sideways for an hour, then moved up, and then eventually found its feet and then moved up. And then you've got the CPI numbers there. The market dropped 100 points, came straight back, and then moved up. Overnight, prices are holding nicely, and you can see they're coming off the 200 MA and the close, oversold with a crossover and moving up 40 points there. It's pulled back a bit there, but it's finding support at the at the 20 and 50 EMA at the moment. Profits so far this week, 1,103. Profit factor 5.13, which is fine. And the win-loss ratio is 61.39. In the S&P, same thing. Market actually closing above the 5-bar moving average, but it needs to get above that 200 MA in order to move higher. If it does succeed in doing this, it will need to take out the 50% retracement there as well. In the 30-minute chart, again, you can see the CPI numbers, the market's reaction to this yesterday. There's the high of Monday. The market wants to try and trade up to the high of Tuesday, which is the same as Monday, give or take a point. In the FTSE 100, also buying coming back in there yesterday, as can be seen there. 30-minute chart. Again, a bit of a shakeout to begin with, and wallop up we go. We had the news from the claimant count yesterday, didn't we? And that's why you got that bit of volatility there in the FTSE. Soon got discounted again. That was bad news, but they moved the market back to the upside there. In the currencies, GBP, JPY still stuck in a bit of a range. It's a volatile range. That said, though, it needs to move higher, get above that 89. At the moment, we're above the 200 MA, which is good, and above this on the overnight. Yesterday, the market moving up 200 points there, then back, and at the moment heading towards yesterday's high for this market. In the pound, also up yesterday, but then selling as the dollar recovered a bit overnight. So we've seen that recovery at the moment, and a bit of weakness there as the dollar continues to move to the upside. 30-minute chart, bit of a mess, as can be seen there, because obviously the dollar also a mess yesterday, which we'll have a look at now. So there's the daily chart of the dollar. You can see that it's sideways. It's red, but it's sideways and holding at the moment. In the 30-minute chart of the dollar index is, as can be seen there, prices are moving up at the moment. A bit of red coming in there as I'm recording, so a bit of weakness there. You'd expect that though, because you've got the resistance across to the left there. And finally in the metals, another slight up day yesterday. There was tried to do some selling yesterday to force the price down. It wouldn't be any surprise to me if they can try and get the price of silver and gold down, because obviously at the moment it's seen as a flight to quality and getting out into something that is a real asset. And I don't mean the futures and derivatives, I'm on about the real physical metals, whereas if you've got it in your own possession, you're out of the system. There's the silver 30-minute. Yesterday it was down, then it came back up with those inflation numbers. Same for gold, up yesterday, sitting at 62% retracement at the moment, but looking weakish overnight, as is silver, like it wants to be hammered back down, just to show that JP Morgan and Bank of America have still got control of this. And finally, let's have a look at the gold-silver ratio. So in the gold-silver ratio, we can see that, again, silver's still outperforming percentage-wise of the gold price at the moment after it's slammed down, which is great. The lower this goes, the happier I will be, as we'll see the underlying markets continue to move to the upside. Okay, that's it for this one. Let's see what happens today, and if any more banks come to light that are struggling. Also, Credit Suisse, keep this one in mind as well. That's already starting to show, well, it's already hit multi-year lows on the share price, but there's a problem there, and we saw this a few months ago, which I mentioned in the market alert about it being bailed out by $5 billion from the Fed, but that was brushed under the carpet. But maybe that's certainly one of the big ones. But like I say, only time will tell. We don't know what secret deals are doing behind the background either, do we? To try and keep the system intact. Okay, that's it. As ever, thanks for watching. See you in the next one.